Hey everybody, welcome back to the Financial Freedom Show. I'm Rob Berger. In today's video, we're going to talk about how we can go about comparing an actively managed mutual fund with an index or passively managed mutual fund. This issue came up as I was talking to a friend of mine who works at a very large brokerage, and we were debating active versus passive investing. And he knew that I invest in a Vanguard balanced index fund. A balanced fund is one that holds both stocks and bonds. And he was pointing out that there's a Fidelity fund that's actively managed that has outperformed the Vanguard index fund over the last decade, even after accounting for fees. And so I thought, well, that's a great opportunity. Let's first look at these two funds, which I'll show you in just a second, and use them to explore how we might go about comparing an actively managed fund with an index fund. So let's get right to it. Here are the two funds. I own shares of the Vanguard fund in a retirement account. This is the one on the right. Its ticker is VBIAX. And the fund that my friend mentioned was a Fidelity balanced fund, VBALX. And again, it's an actively managed fund. Vanguard, as you can see here in the name of the fund, is an index fund. Now, the first thing to point out is, yes, expense ratios matter, and the Fidelity fund costs 51 basis points. Actually pretty reasonable as actively managed funds go, but still half a percentage point's pretty expensive. The Vanguard fund, just 7 basis points. But remember what my friend said. He said, yeah, but the Fidelity fund has outperformed even after accounting for those expenses. So I thought, let's check it out. So let me make this a bit bigger. I use Portfolio Visualizer. I put both funds in here. There's Fidelity, there's Vanguard. Actually got 20 years of data. And when we look at the results, sure enough, he's right. $10,000 in the Fidelity fund generated over $48,500 with a compound annual growth rate, which factors in the expense ratio of 7.63%. And my $10,000 in a Vanguard fund would have only grown to just over $37,000 with a compound annual growth rate of 6.29%. Here's the critical thing to keep in mind. We can't stop our analysis there, because what we need to find out is, are we comparing apples to apples? Do they both invest? Is their stock to bond allocation the same? Is their stock approach the same? Does one invest in riskier bonds than the other? We sort of need to dig into the details before we can conclude, yep, that Fidelity fund actually gives us more bang for our buck, so to speak, than the index fund. So let's do that. And I want to begin by actually just looking on their website. This is the Fidelity website. We can see their stock bond allocation here. And here's the Vanguard website. And both of these, as you can see, are as of June 30th. They update these, I think quarterly, but same date, so that's perfect. And you can see the Vanguard balanced fund has just under 59% of its assets in equities, stock. Compare that to Fidelity, and we see a big difference. Fidelity has what, 63.25 in U.S. equities, 379 in international stocks. So that comes out to what, about 67%. So that's a very significant difference in terms of the stock bond allocation. So we can't simply just compare these funds and pick the one that has the higher return because their approach to investing is notably different, just the stock bond allocation alone. Now, to try to deal with that, I decided I would look at the allocation according to Morningstar for the Fidelity fund, and let me show you that. It's slightly different than what Fidelity actually reports. They show here 65.5% U.S. equity, 4.6% international, and then the rest, not just this 29, but a few others here, in fixed income. That's a little different than what Fidelity is showing. We'll actually come back to that point in a minute. But I used these numbers to try to back test a portfolio. And let me make this a bit bigger. So I use those numbers over here with a 3-fund portfolio. So I just use a Vanguard total stock, U.S. stock fund. Their VXUS is an international fund. BND is a bond fund. And I put those percentages in here, and I ran the numbers. And I got about 10 years worth of data, as you can see here. And here were the results. Fidelity Balance still outperformed, but not nearly by as much, but still it outperformed. We can't argue with the data. 9.77% compound annual growth rate, and again, that's after the expense ratio, versus 9.3 for my sort of made up sort of index fund version of the Fidelity Balanced Fund. Now, when I saw those numbers, I thought, well, it's awfully close, but is this a fair comparison? And it turns out that it's not, for at least two reasons, and I want to show you that. So let me go back. Remember, we were looking at the allocation here in Morningstar versus what the Fidelity Fund is showing, the Fidelity website. And you'd probably, at least I would probably credit Fidelity's website over Morningstar's, but it's actually more difficult than that. And let me show you why. Inside of Morningstar, when we're looking at a portfolio, and we come down here, we can actually, this is the style map for their stock portfolio. You see it's a little tilted towards growth, definitely a large cap exposure, but there's a historical tab here. And if we click that, it will show us for the last 5 years how the style box has changed, if at all, and the equity percentages. And you notice here they've changed kind of dramatically. In 2018, its exposure, and I don't know if this is as of the end of year in 2018, but it was 63%. According to Morningstar in 2022, it's almost 69%. And actually, I did some more research on this, mainly from Morningstar. It turns out that the equity allocation in the Fidelity Fund tends to change over about a 10 percentage point range. It's been as high as 72% just a few months ago at the end of 21, and it gets as low as we've seen into the low 60s. So it changes dramatically over time, and that presents a problem. If we come back to our attempts here, let me make this bigger again, to try to model the Fidelity Fund using some of percentages, I could pick from the Fidelity site, from the Morningstar site. It really wouldn't matter because over time, these all change by a pretty significant margin. So that's the first challenge when it comes to trying to compare the Fidelity Fund's performance to index fund, to sort of an index fund portfolio. But there's a second challenge. Notice that I've used B and D for the bond fund, and that's the approach that the Vanguard Balanced Fund takes. So what's the problem there? Well, let's go back to Morningstar, and I want to look at the portfolio for both the Vanguard Fund here. We've already got that for the Fidelity Fund here, but I want to go to bonds. And I'll go to bonds for Vanguard. And I want to go down to where it shows us what's called credit quality for both of these balanced funds. And the way to think about this is the AAA would be bonds issued by entities that are the least likely to default. These are the best of the best. And as we move down these grades, each step down, the risk of default goes up. When we get to BBB, that's the lowest credit rating that would be considered investment grade. And then BBB and down would be junk bonds or high yield. Notice here, there are some significant differences to the bond portfolio. Vanguard has 71% in the AAA, Fidelity just 61%. When we get to the BBB, the bottom, the triple B, bottom of the investment grade, Fidelity's goes up 21.5% versus Vanguard's just 14%. And then, while it's not a big number, Fidelity does have some junk bond and these not rated bonds here. And as a practical matter, Vanguard doesn't have any of those. And so the bond portfolio is significantly different between these two funds. Now, it's not that one is right or wrong. I don't have an issue with Fidelity having some exposure even to high yield, but it makes comparing the two funds and their returns very difficult, at least at that level. So what I did from there was I looked at some of the risk measures, specifically the Sharpe ratio, to try to get a feel for how these two funds are performing on a risk-adjusted basis. Let me show you that. So again, in Morningstar, we're going to go over to the risk tab for both of these. Here we go. And I want to focus on the Sharpe ratio. We should see that, yeah, right there. So here's the Sharpe ratio. Now, the Sharpe ratio, let me show you for the Vanguard fund. Here it is for Vanguard. So 0.61 for Fidelity, 0.46 for Vanguard. The Sharpe ratio, the idea is to compare returns to risk. So what's your return on sort of a risk-adjusted basis? It's actually a fairly easy formula. You take the fund's returns, you subtract a risk-free rate of return, think a U.S. government bond, and then you divide by the standard deviation. And the higher the number, the better. And generally, you know, it depends on the kind of fund or investment, but a quote-unquote good Sharpe ratio might be 1 or higher. I don't exactly how that kind of metric would apply in a balanced fund, one could argue. But I think for comparison purposes, it's quite helpful. And you might say, well, Rob, I mean, if higher is better, I mean, you know, 61 is higher than 0.46. So, well, here's the deal, though. You also have to think of the time period. See up here in the corner, 3-year? I prefer to look at a longer time period. At a minimum, I would want to go over an entire complete business cycle. But for Morningstar, we can go out 10 years. So let's do that. So for Fidelity, it goes to 0.87. And for Vanguard, 0.87. They're actually identical. And so my takeaway at the end of the day is, one, I think the Fidelity fund is a great fund. I think it's performed, again, as we saw in the Sharpe ratio, on a risk-adjusted basis, comparable to the Vanguard index fund version. Again, the absolute returns are going to be higher on Fidelity, but that's because it's investing in more equities and more bonds that have lower credit quality. And so, given that, you would expect to see absolute returns higher. But on a risk-adjusted basis, I don't think there's a significant difference, if any, in the returns, particularly on an after-fee basis. Now, that raises the question, well, Rob, why did you pick the Vanguard fund? And what would be some considerations in deciding what might be best? Well, in my case, I just generally prefer the index fund. I can look at a Fidelity fund like what we just saw and see that, yeah, over the last 10 or 20 years, it's done well. But I'm not sure I'm comfortable relying on the managers of the fund to keep doing great work, particularly when on a risk-adjusted basis, it doesn't seem to provide any real extra return. But there are two other practical reasons, at least today, I probably wouldn't use the Fidelity fund. And the first we've talked about, but I'll go back to it. Remember, for the Fidelity fund, the asset allocation changes over time by about 10%. We looked at it just a minute ago. We can go back to the historical tab, right? I picked the Vanguard fund because I wanted it to affect my overall asset allocation in a certain way. And so I really needed a 60-40 portfolio. So not only is this not 60-40, but as we saw, it changes from year to year by as much as 10 percentage points, which would mean my overall asset allocation would be changing too. And I don't want a fund to do that. I want to control my own asset allocation, and I can't do that with this fund because the fund managers have that kind of leeway. With the Vanguard fund, and we can look at it, come over here. There is actually some variability with the Vanguard fund, but it's much, much smaller. The Vanguard fund can actually drift by about 200 basis points, and they do that in part for transaction costs. They don't want to have to rebalance daily or weekly or monthly just to keep within some very, very rigid asset allocation. But when we look at the historical, it's about a 2% difference, as we can see right here. And that's probably about as good as you're going to get in a balanced fund. But for me, that's okay. 1 to 2% drift, I can live with that. Can't really live with a 10% drift. It's going to change my asset allocation in ways that I don't want. Then the last thing I'll mention, and another concern that I would have, whenever you're dealing with an actively managed fund, you always have to think, who's the manager? How long have they been on the job? Are they good? And what happens if they leave? Well, the manager on the Fidelity fund is this gentleman, Robert Stansky. He's been, I think, with this fund, since 2008. And guess what? He's leaving this year. And, that happens. A gentleman by the name of Christopher Lee will be replacing him. But that adds another unknown. Now, it may turn out that Mr. Lee is phenomenal and the fund continues to perform well. But given its history, I can't see it outperforming on a risk-adjusted basis. And so for me, it's just not worth 51 basis points and the risk that a manager might begin to underperform and the variability in the stock to bond allocation of up to 10 percentage points. Those factors for me just make it not worth it. Now, of course, what's worth it for you? Maybe it's a perfect fund for you, and you can decide that. But I thought this would be just a helpful way to think, sort of a framework to think about comparing an actively managed fund to an index fund. The real key is that when someone points to a fund and says they've outperformed their benchmark by whatever over a period of time, you can't just take that at face value. You've got to dig into the details of the fund to understand exactly how meaningful that outperformance may be. Well, there you go. Hope you found this helpful. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is a good editor for these videos. Forget editors. Who needs them? It's financial freedom, and I got that. Hope you do too.